Goldman Sachs CEO David Solomon has struck a sobering note on the economic outlook. Yahoo Finance editor-in-chief Andy Sower sat down with Solomon at the Milken Conference.
I guess the first question is pretty obvious. We have had the worst start to a year, January through April, I think, in like 80 years. How are you worried, David? Are you concerned? What's going on? How do you explain it? And what's your take on the capital markets right now?
Well, we're going through a period of change and shift after a long period of monetary policy that was very, very accommodative. And there are a handful of things that have happened over the course of the last few years that have led to a relatively abrupt change in policy. And that change in policy is affecting asset prices. That change in policy is trying to unwind the inflation that's now rooted in the economy. I'm concerned about the path of this. I think we'll find a path through. It's hard to estimate whether we'll have a soft landing or whether we'll ultimately have to have a recession to slow down this inflation that's embedded in the economy. But we're really getting a response to a combination of loose monetary policy, the pandemic, the disruption it caused, significant fiscal policy, and we're now coming out of the pandemic and trying to unwind all that in a much more complicated world. I think the situation in Ukraine has made the world more complicated. Geopolitics in China have made the world more complicated. And so we have a more uncertain period that we're all going to have to navigate through.
It seems pretty clear the Fed's going to raise by 50 basis points this week. How confident, David, are you in what Jay Powell is doing in his course of action right now?
Well, the Fed is on it and it's focused. I think that the perception of how aggressively they're going to move to raise rates has changed over the last couple of months. But the course of that and whether or not they can land the plane very smoothly is uncertain. But I know the Fed's focused on it, and that's a good place to start.
Are you changing the strategy or the objectives of the firm at this point because of maybe this sea change in rates or even in the macro environment sort of over a 5-year period? How is that affecting how you're managing things?
We laid out in 2020, a strategy to continue to grow Goldman Sachs, diversify the revenue base of Goldman Sachs, and find a broader set of products and services that we could deliver to serve our clients and our customers, and we're executing on that. This is an environment that probably creates some headwinds versus the environment we were living in and operating in 2020 and 2021, but it doesn't change our strategy, doesn't change the way we're executing against that strategy. Might slow some things down a little bit, but we're focused on executing and making sure that we're making the firm more durable while improving the ways that we can serve our clients.
All CEOs are dealing with interest rates, supply chain, labor shortages, maybe not supply chain for you so much. Does supply chain affect Goldman Sachs?
Well, supply chain doesn't affect Goldman Sachs the same way it would affect a manufacturer, but when you think about our business, a lot of our business is delivering intellectual capital to our clients, and that requires us to have extraordinary people, and the world right now is very competitive. Labor is very, very tight, and so like all businesses, we're working to ensure that we're attracting, developing, supporting our people, and that's a super important part of our supply ecosystem, is making sure that we've got the best people who can really work with our clients to help them deal in this time of uncertainty.
One of the big questions of our time, I think, David, is about globalism. And we had this sort of unimpeded rise of globalism since World War II. We were just talking about the Clinton era. Maybe that was the high water mark. China entering the WTO. Obviously, over the past 5 years, we've seen a retreat in terms of globalism. You're a global firm. This obviously has consequences for you. And I think the question is, sorry it's long-winded, is this just a blip? Or are we seeing a major change back to nationalism against globalism?
Well, I've talked about this a couple of times today in discussions, and I think it's never black and white. It's not forward reverse. Right. But there's no question that there were a variety of macro factors that, in my opinion, really led to, more capital flow on a global basis around the world. I think the fall of the Berlin Wall ushered in a period of really thinking about what's the cheapest place to make something so you can therefore sell it to wherever demand is in the world. And there are some things going on right now in the macro that are causing people to reconsider some of that. I think there's certainly significant shifts going on in where people buy energy and how people think of where they get their energy and energy security. I think people are thinking about their commodity supply chains. I think people are obviously thinking about food. And so I think there certainly is a shift toward more regionalization and more nationalism, but I would be quick to call an end to the global economic system we all participate in. I think we're pretty economically connected, and while there's some rebalances and changes, I don't think it's a straight out reversal.
Shifting gears a little bit, does it concern you that so much capital has flowed to parts of our capital markets that are not regulated by the SEC? Maybe in terms of it being riskier, in terms of systemic risk, that there's so much money in hedge funds, private equity, venture capital, that's not directly overseen by the SEC? And then is it just simply unfair to Goldman Sachs that you have to play by these rules and those guys don't?
Well, we're a regulated financial institution,
right,
and we have certain activities that are inside what I'll call the regulated moat. We also operate in a variety of those businesses. We're a big asset manager.
Right.
We're one of the top 5 active asset managers in the world, and so we operate in those businesses too. I certainly wouldn't say it's unfair. I do think that there's a lot of activity that used to be in the regulated banking system, a lot of lending activity that's moved outside the system, and I think that's something that everyone needs to watch over time. But broadly speaking, I think markets are relatively efficient. We participate in those markets, but we're a regulated entity. We accept that, and we operate our business to be as successful as a regulated banking entity as we can be.
What are the greatest opportunities you see in the capital markets, or maybe just equities, or the greatest opportunities for the firm? I think it's maybe 3 questions, but go ahead.
I think the innovation economy in the U.S. is alive and well, and I think there are incredible opportunities. I think there's enormous change going on in AI and robotics. There's great opportunity for risk capital to come into areas where new technologies can be developed to accelerate climate transition and really improve our ability to deliver, a greener world more broadly. I think there are enormous opportunities in biotechnology and medical technology and great advances occurring that can obviously help us all and help the people we love. And so I think there's a great innovation economy that's alive and well. Those are 3 big buckets I'd highlight, but the opportunities that will come out of those areas in the coming decades are enormous. And we're trying to find ways to support clients, allocate capital, intermediate, and support that investment and that activity that only strengthens the overall U.S. ecosystem.
Last question, David. And it has to do, you mentioned the possibility of a recession. So what specifically is your outlook? You can lean on the firm economists if you want for that.
I'll lean on the firm economists.
Yeah, right. But so what are they saying? And what does that mean for the core businesses, the IPOs, the M&A, capital markets stuff?
So our U.S. economics team, forecasts about a 30 or 35% chance of a recession in the next couple of years. And I said in a panel I was on earlier, I don't think speculating whether that's high, low, is it 30 or 35, is it 40 or 50, I don't think that really matters. What matters is we're going through a period where there's real inflation, we're seeing a shift in monetary policy, we're raising rates,
right,
and the risk of a recession is higher than we perceived it was 12 months ago. And so people have to think about risk appetites, risk capacity according to that, and they have to discount appropriately. And so we think about our risk appetites. As we talk to clients and advise clients, we tell clients you have to be prepared that in the distribution of outcomes, there's a larger possibility of an economic slowdown now, given what's happening than there was, a year or 2 ago. But I'm sure we'll navigate through it, and hopefully we'll have as soft a landing as we possibly can.
Quick last question, David. Have they asked you to DJ at the party this afternoon or tonight?
I'm working on Goldman Sachs business this week, so all Goldman Sachs this week, no music this week.
Okay, serious stuff here. David Solomon, CEO of Goldman Sachs. Thank you so much for joining us.
Great to be with you, Andy.